All right, good afternoon, gang. Welcome to my weekly market update. So it is 3:01. Sorry, I'm a quick minute behind. Was having trouble getting my Facebook Live connecting so I could stream this onto Facebook. But it is now connected and away we go. So let's dive in because I got a fair amount to cover today. Don't forget to post questions on chat. So if you're on Zoom, post your questions on Zoom chat. I'm opening up the chat window right now. There we go. And hi, Beth. And if you're on Facebook, I will try and catch the chat on Facebook, but I don't watch that anywhere near as much, so I'll catch it more on Zoom. And if I miss you on Facebook, I'll catch it later. All right, so away we go. So where are we going to cover today? We're going to cover a rate update, as I always do. Let's mute. There we go. All right. So we're going to cover rate update like I always cover. I'm going to cover an exciting new program we have. A 15% down payment jumbo loan is coming out effective today. So super, super excited about that. I'll be sharing the truth about how interest rates work. And specifically how rate locks work, because there's a lot of confusion about locking an interest rate. My industry has perpetuated that confusion, and I'm going to tell you the truth today, but it's probably going to create more confusion than anything else. But you deserve to know the truth. So I'm going to give you the truth today about interest rates and how all of that works. So we'll talk about that, and then I'll cover a couple of my upcoming webinars, and we will be done. So let's turn on my handy dandy little spotlight thingy so you can see. Why is it not spotlighting? Oh, well, it's not spotlighting. That's okay. Anyway, and let's go. So let's dive in. Come on, computer. There we go. All right, so the market is continuing to be volatile. We're seeing a lot of volatility over the last couple of weeks, a lot of reasons for that volatility. Definitely causing questions and concerns in the eyes of consumers, specifically about the advice that I've been giving all along about, hey, it's not a good idea to lock interest rates if you're refinancing, and the Fed adding that hit for refinances definitely threw my clients for a curve. I will tell you, I've run the numbers for 95% of my clients, except the ones that I had talked to about numbers the day before that advice came out. We're still better off now than we were before that hit happened. So the clients are, the advice I gave about, hey, I think rates are going to stay the same or get better is holding true. Again, it's over the long term. So if you're looking to purchase and you have a short close of escrow, if you're a 30-day or less close of escrow, lock right away, because we're seeing instability in the market right now. We're seeing ups and downs. Not a huge difference in interest rate, but it's making enough of a difference that it's not worth taking the risk if you're purchasing a home. So my advice hasn't changed at all. There's going to be some wild cards that are coming out there, but overall, the Fed is continuing to push the market lower, and we're going to continue to see rates either stay the same or get better. All right, enough on that. I want to share the most exciting news I've had in a while, and I'll rewind real quick and say, guys, it wasn't, 5 months ago. Man, it's been 5 months. So March 16th is kind of when everything went to hell in a handbasket, kind of where things got a little more serious about the COVID shutdown, and we had some huge pullback in the marketplace when it comes to mortgage loans. We went from having 5% down jumbo loans or combo loans where I could do a first and second to literally having no jumbo loans overnight. The combo loans were still there, but they started going away after a couple of months as well. And there was a period of time a couple months ago and we had no jumbo. We had no programs that could do a first and second combo loan to help somebody that was in jumbo territory. And finally, jumbo started coming back, but it came back ugly. And the rates were high. The appetite for investors was really, really low. We had one and then two investors that were willing to do jumbo loans, and it became super, super tight in the jumbo market. And I'm really happy to announce that that market is starting to loosen up. So effective today, we have a 15% down payment jumbo loan. And that is a great, great product for clients who obviously have little funds available or less funds available for a down payment and want to minimize their out-of-pocket cost. But remember, everything comes at a cost. So the 15% down payment loan, we can do up to a $1 million loan amount. You require a 740 credit score. So the client has to have a 740 credit score to do the 15% down. I can do, with this particular program, a 700 credit score as long as you have 20% down. The debt to income ratio, everything is about layered risk. They're not going to take a risk on a high debt to income ratio with someone that's doing a small down payments. So you're looking at a maximum of 36% debt to income ratio if you want 15% down. If you're looking at 20% down or more, we can go up to 43% debt to income ratio, and 12 months of payments are required. That's the bad news. Now, let's talk about interest rates. You ready for the really bad news? It's not bad at all. The interest rates for the 15% down, I ran numbers at a 780 credit score. Again, high credit tiers are important. 780 credit score, 15% down, 3.25 with 1 point on a 30-year fixed. That's a super, super good interest rate. With this same investor, I ran numbers with a 20% down payment, and it's a 2.99 or 3% on a 30-year fixed, paying 1 point with 20% down. That is a screaming good interest rate, and we have not seen rates on fixed 30-year fixed rate mortgages for jumbo loans that low in 6 months. So really, really good news on that end of being able to get 30-year fixed jumbo loans at aggressive interest rates. This investor is one of our favorite investors. They deliver what they say they're going to do. They haven't had issues with not purchasing loans, so we can be pretty aggressive in underwriting. Bottom line is, really good news. Best news I've had in a long time when it comes to the jumbo market. So spread the word. You have people who are looking at low down payment jumbo loans. We can do 15% down on a jumbo loan in the low threes. So super, super good. And I think I did put it in here. Cool. We're looking at 3.25 with 1 point, as I said, or 3% with 20% down. Other good news is I just got news that we got our combo loan back. So we can do a first, second combo. That means that I can, maybe somebody wants to buy a house, an $800,000 home, and they want to put $200,000 down. The problem is they don't want to go jumbo because they don't have the reserves to go jumbo. Well, until we had our combo loan back, we were in trouble because the conventional loan limit, if you're in San Joaquin County, is $510,400. That means that they'd have to come up with $90,000 more than they wanted to come up with. But with the combo loan, I can loan them that $90,000 as a second mortgage, and I can technically go as high as 90% loan to value on that second. Now, I haven't been able to look up interest rates on that, but I've heard from my colleagues the rates are pretty ugly, like 6%-ish, 7%-ish on that second. So the combo loan is back, but it comes at a cost. And so that's where that's where I'm super excited about having the 15% down jumbo, as long as they have the reserves. Again, everything is a trade-off. That jumbo product, you got to have 12 months of reserves on top of your down payment and your closing costs. With the first, second combo, you don't have to have any reserves. We're doing a conventional first. I can go higher in debt to income ratio. So we've got a lot of flexibility there, but you don't have the benefit of the really low interest rate on that extra money that you're borrowing. So again, everything is a trade-off. All right, so I'm going to dive in now, and I'm going to talk about how interest rate locks really work. Again, guys, if you have questions about anything, feel free to post it in chat, and I'll answer it. I probably got 10 minutes worth of conversation on this, so if there's no questions, I'll get you out 10 minutes early. So here's the deal. I want to kind of give you a big picture of who the players are when it comes to interest rates. You've got the originator. That's the bank or the broker that's originating the loan. They're the ones on the front end that are telling the consumer, hey, here's your rate that we're going to offer you today. And I will tell you that there's a lot of confusion out there about, well, does that mean that, Wall Street, who we're finally selling it to, the investor at the end, are we going to the investor and saying, hey, here's the rate you're going to get for the Smith transaction at 123 Main Street that you're going to start collecting interest on in 30 days? The answer is no. Okay. It's kind of like unlike when you buy an airline ticket, like you buy an airline ticket, you're buying it from the airline and you're saying, hey, I'm flying on that flight in 30 days. Here's my money to pay for that flight. And you are prepaying for that flight. That is not what's happening. It's basically, we have all the risk. In the lending world, we have all the risk on our side by saying, look, once we lock an interest rate, we can't get out of it. We have to honor the rate that we had promised, but the consumer can get out of it. The consumer has no cost, no recourse, no loss on their end. If they change their mind and say, I don't want to buy the house, well, there's no hurt on their end. There's no pain on their end for getting rid of that rate lock. On our end, there is. And here's why. Because as the originating bank, we have to offset the risk of rates going up. That's our fear. Our fear is we tell somebody right now, I promise you a 2.75% interest rate, because that's what the market is paying today. If we closed a loan 2 weeks ago and sold it today to the Wall Street's paying 2.5%, 2.75% is what they require for a loan. I'm giving you that as a theoretical example. But we're not going to close this loan for 30 days. And then it's going to take 2 weeks after that before we sell it to Wall Street. So how do we know how much Wall Street is going to be buying loans for in 30 days, in 45 days? We don't. And we can guess, but the truth is that's a pretty bad business model if we're basing our profitability as an industry on guessing where interest rates are going to go. So I want you to think about yourself like you are like you're a real estate agent. Haha, shocker. And instead of you being in the transaction the way that you're in right now, let's pretend that your role in the transaction is to promise the client they can buy a house at a certain price, but you're really not going to go buy that house for them for 30 more days. Prices could go up or down. So you say, hey, Mr. Client, you can get this house for $400,000, just like it. You can get it for $400,000 somewhere in this neighborhood. And they say, cool, handshake, I'll take it. I'd like that house for $400,000. What you don't know is 30 days from now, is it really going to be $400,000 for that house, or is the price going to go up to 410? Because if it goes up to 410, you lose, because you promised him you'd sell it to him for $400,000, and now you got to pay 410 to buy it. Now, if the value of the house drops in the next 30 days, you win, because you end up buying the house for 390 and you promise to sell it to him for 400, so you win. But you really don't win, because he'll cancel that transaction with you and go buy it from somebody down the street because he knows that the values have dropped to 390. So it's kind of a lose-lose, because if you're selling that house, and I'll go back to my example of the interest rates, if we lock in a rate at 2.75 and rates drop, the client theoretically can say, oh, no, thank you. We don't want that rate from you because somebody else can give it to us at 2.5. Yet, if we locked you in at 2.75 and rates go up to 3%, we lose money, because we're selling that 2.75 rate into the market that expects a 3% return. So it's a backwards system that says it's really stacked against the bank. Now, I'm not asking you to have pity on the bank. What I'm trying to help you understand is how the bank is in a tough position. It would be great if rates drop because the bank makes more money. And why shouldn't we just pass that along to the consumer? Or even if rates stay the same? So many questions are asked when I locked you in at 2.75 and 30 days later, we haven't closed yet and rates are still at 2.75. And they're like, hey, why are you charging me an extension fee when I could just cancel and start over right now at 2.75? Here's why. Because when we lock in interest rates, we are buying an investment in something that moves the opposite direction of interest rates. So think about that for a second. Let's pretend that, I don't care what it is, the value of something that's inverse to something else. So the value of popsicles compared to the value of wool jackets, okay? So when do you want a popsicle versus when do you want a wool jacket? You want a popsicle in the summertime and you want a wool jacket in the wintertime, right? Like you don't want those at the exact same time, because if you are cold, you need a wool jacket. And if you are hot, you want a popsicle. So the value of those two go back and forth. When it's hot, the value of a wool jacket is really, really low. Nobody wants it. But when it is cold, the value of the wool jacket is premium. Same is the opposite fact of popsicles. When it's cold, nobody wants a popsicle. So the value of the popsicle when it's cold is super low. So if again, I want to tie this analogy to have it make sense to you. When we lock an interest rate, we're saying, look, we're going to buy something that goes, if the value of rates moves up, then this thing goes down. And if the value of rates go down, then this thing moves up. So we're buying something that moves, just like the relationship between popsicles and wool jackets. By the way, I just came up with that on the fly. Do you like that? I do. All right, so the value of popsicles versus the value of wool jackets are going inverse to one another, just like the value of mortgages and values of other investments are inverse to one another. What that means is if interest rates fall, you would think, well, the bank's going to make a lot of money, except that the value of the hedge, the investment we made in something else, Now you want a popsicle. I agree, Penny. Let's popsicles for everybody on Penny. Just try and collect. All right, Penny, can you Venmo everybody like $1 for popsicles? All right, so what you got to recognize is we make the same profit no matter what, whether the rates go up or down. If rates go up, then okay, let me think about this for a second. If rates go up, that's bad for us because we've locked in a rate lower and that's not worth as much money for us. But we made money on our hedge. Therefore, it offset and we made the exact same profit at the end. Rates go down, that's good for us, but we lost money on the hedge. Therefore, like if you're thinking, hey, it's heading into October and it's going to be wintertime and I'm going to stock up on wool jackets, but you made a mistake and it's hot, well, then good thing you hedged your bet a little bit and you bought some popsicles on the side because now you can go sell the popsicles for a profit to make up for the money you lost on the wool jackets. I'm trying to extend my metaphor here. So very simply, the longer we hold the hedge, the more expensive it is to us. We have a cost of that investment in holding that investment. And if we lock for 30 days, that's a certain dollar amount of cost. If we lock for 45 days, the hedge, that other thing that we're buying, is more expensive because we're owning it for a longer period of time before we sell it. And there's more risk to it. And so that's why longer rate locks cost more than short-term rate locks. And even if the rate is the same, we've still had the cost of the hedge, the cost of that investment that we bought, the cost of the popsicle. We still had to buy the popsicle even if we throw it away. If in the end it ends up being, super cold and the popsicle sooner or later is going to go bad and nobody wants a stale popsicle. I don't know if popsicles go stale. Penny, let me know if popsicles can go stale. The point is, sooner or later the popsicle is going to go stale. Nobody's going to want to buy it, or the other way around, and it ends up being a really, really warm winter. And now the wool jacket is out of style. God forbid you have last year's style of wool jacket, right? Same concept, different type of product we're talking about here. But the key is that risk all exists at the originator, at the mortgage bank. The next person in line is the warehouse bank. And the warehouse bank basically gets the loan. They fund it for us and hold it for that 2-week period until we sell it to Fannie Mae or Freddie Mac. Summit Funding acts as their own servicer. So basically the warehouse line funds it. We end up as the servicer, but we've sold the loan to Fannie Mae or Freddie Mac. This is when the actual rate is determined. When we sell the loan to Fannie Mae or Freddie Mac is when we've actually got it off of our line and we've sold the loan. But in the meantime, you have what in the industry we call pair off cost. And that means very simply that every time we lock a loan, we're buying a hedge against that loan in case the rates go up or down so that we can make the same amount of money no matter what. But we know not all loans are going to fund. And that's a really important piece the bank has to guess on. We have to guess and say, okay, in zip code 95240, what percentage of transactions that go into escrow close escrow? Because we can't buy a hedge on every one of our loans that we've locked because we'd be losing money because we know that a certain percentage are never going to close. And that closing percentage gets lower and lower when we extend the rate lock. That's another reason why even if rates are the same and we extend the rate lock, that loan has become stale. Think about any home that you're in escrow with. If you're in the initial timelines on it, you're pretty good shape. You think it's going to close. But if you need to get extensions on there, you start worrying. What's really going on behind the scenes? Is this transaction really going to close? Now the buyer comes back and asks for another extension. Now you really start worrying. Are they really telling me the truth? Is this deal really going to happen? Is the lender going to perform? If the lender's John King, yes, the lender's going to perform. If it's anybody else, who knows whether they're going to perform or not? All right, take that for what it's worth. My point is that you've got all those questions you ask as the seller and as the listing agent. We know the same things to be true. We know some deals aren't going to close. And so thanks, Randy. So that's a big part of in the lending industry of why when we have a rate that goes to 30 days and now we're gonna extend that rate lock, the chances of that loan closing just dropped significantly. The percentages, the pull through on an original locked loan to funding is X. Let's say it's 80%. So 80% of the loans we lock fund. But when you extend it, after the first extension, maybe 80% drops to 60. And after the second extension, 60 drops to 40. A lot fewer of the loans actually close when we extend them. That's why we have to add a much higher fee on the extension, because we've hedged those locks and only some of them are going to close. The ones that do have to pay for the ones that didn't. It's just like anything in business, guys. There's no such thing as a free lunch. Those lenders that say, oh, we don't require our buyers to pay for appraisals up front. Well, that means they charge everybody an extra fee to pay for the cost of the appraisal. Nothing is free in a for-profit organization. So if you think that, hey, this one that cancels and falls out, oh, well, no harm, no foul, the more cancellations a lender has on their locked loans, the higher interest rate they have to charge across the board for all of their loans. That's why it's super important we're only locking good quality loans. We know a certain percentage aren't going to close. But that's a big piece of this conversation, is really understanding how the hedge works. I don't even understand how it works. I'm not asking you to understand how it works. I just want you to understand the basic concept. We as a bank have all of the risk. Remember, if rates go down, that's great for us. We make a whole bunch of money. No, we don't, because we bought an offsetting investment that loses money when rates go down. So we made money because rates dropped, but we lost money on the hedge. If rates go up, we make money on the investment we did, but we lose money on the interest rate. We end up whole no matter what, unless the deal cancels. Then we've spent the money on the hedge and we didn't make any money on the loan. That's why extensions are expensive. There are limits to how many times a bank will extend a loan, because they're stuck holding the bag of hedging against the risk of rates going up, and there's a cost to that across the board. Really, really complicated. If I were to go any deeper, if you know enough about the subject, you know I didn't go very deep at all, but hopefully I gave you just enough of an understanding, because that's a question people get all the time. And here's the simplest answer I give people. The truth is, I just tell people, look, we set aside the money. We didn't set aside the money, but we bought other investments. So it's easier to explain to consumers. As the bank, we set aside the money now, and we expected to start earning interest on that in 30 days, and we're not earning interest on it. And therefore, there's a cost that we have incurred because we're not receiving interest as soon as we had hoped. That's the easy way to say it. That's not really the truth, guys. But if I tried to explain to your clients what I just explained to you, their head would explode like yours just exploded. So I want you to understand how it works, but the truth is, this is for your information. If somebody really presses the issue, I need you to understand how it really works. We are not making money. We're not making our industry boatloads of money on the hedge, but we have a risk. The risk is what Fannie Mae and Freddie Mac did to us a week and a half ago. When they added a 0.5% in fee on all loans we delivered to them after September 1st, we had already locked those loans a month ago. And when they did that, that means it comes directly out of our profit. We can't pass that on to consumers. That is part of the hedge cost that says, well, the cost of it, the loan got a whole lot higher, but did our investment really change on the hedge side? And are we really losing money or not? That's the part where this all gets a little more complicated, but the bottom line is there's a lot of parts that are moving here. And very simply, what I want you to understand, the key I want you to understand is, even when rates stay the same, which is the thing that blows people's mind, why can't I just keep the same rate and not pay another fee for extending it? You need to understand it. We need to pay that fee because of the fact that we have a cost on the hedge that we have to cover. And secondly, because the chances of that loan closing have diminished significantly, and we're gonna lose money on the hedge of all of the loans like it that got extended, and we have to recoup that cost somewhere. Hopefully that made sense. I have a feeling that since I only got one comment about somebody wanting popsicles, that it might have gone over some of your heads, but I know you guys are super smart people, so you'll figure it out. Watch this replay 14 times, you'll figure it out. Guys, I just want you to understand that, because these are questions that I'm getting from your customers, and I want you to have enough information to respond knowledgeably and help guide them through the process. All right, last thing I always cover is my upcoming webinars. So this Thursday is a good one. It's my first time homebuyer webinar. So that's my best attended webinar. It is going to be Thursday, the 27th at 5:30. So if you know anybody who is a first time homebuyer thinking about buying anytime in the next year, then send them to rsvpwithjohn.com to register for this Thursday's webinar. I did get a question. Elizabeth said, are buyers on work visas allowed to purchase with jumbo loans? I have no idea. I can look into that and get back to you. Honestly, I don't know. I mean, the rules are so different. I can't think that I've ever tried, but it's a matter of just looking up the guidelines and figuring it out. So I'd be happy to check on that for you, Elizabeth, and get back to you on that. So I'll shoot you an email this afternoon and let you know. Aside from that, guys, if you don't have any other questions, please let me know. Elizabeth Vieira, I'm assuming, because I only see your first name. So if it's not, give me your last name, Elizabeth. Yes, okay, cool. All right, so anybody else have any other questions, let me know. Otherwise, guys, I hope you have an absolutely amazing week. I look forward to talking to you soon. Don't forget about me when you have buyers that need help. I am here to serve, and I will take great care of them and great care of you. Have a good week. Bye-bye.